They say the data is out there, but most people scroll past it. They look for vibes instead of signals, and they pay for it years later. No slogans, no fluff, just real numbers with real consequences. And one man who can make sense of it all, ANZ's senior economist Miles Workman. If you own a property or want to, this might be the most important episode you've watched all year. If you like making money rather than watching everyone else do it, hit that subscribe button because the numbers don't lie. More investors are getting the New Zealand housing and real estate intel from this show than any other YouTube channel in 2025. Miles, what are you projecting to be the increase in property values?
So our forecast has annual house price growth ending the current year up 4.5%, and then accelerating a little bit further to about 5.5–6% in the following year. So that's not very strong growth, relative to historical trends. You could say the average over the past decade was sort of closer to 5.5–6%. But at the end of the day, we are perhaps in a slightly different paradigm than we were prior to the pandemic, in the sense that, first of all, the Reserve Bank has its new debt-to-income ratio restrictions, which are a potential constraint to how fast house prices can grow relative to incomes. But then you've also got the affordability constraints as well, where obviously these measures, house prices to income, for example, they've come down a lot since the peak when everything went basically bananas following that COVID stimulus period. But they're still elevated relative to history. So I think the upshot is our house price forecast is largely anchored to what we think will happen with the household sector and household incomes, which ultimately means we're forecasting a relatively stable ratio between house prices and incomes. And that's our key anchor in the medium term. So the upshot being is, if the economy somehow comes through a little bit stronger, then we are forecasting, and that the type of growth we get isn't overly inflationary. Perhaps it's a really good news story, and we get a lot of productivity, and it doesn't lead to high inflation as we get higher growth. In that world, there would be scope for house prices to grow a bit faster than our forecast. But yeah, that's the key anchor we see, I think, over the medium term is the affordability constraints and the DTIs are biting.
And as we take a closer look at the trends in the New Zealand economy and housing market at the moment, what do you think, given the level of government spending that Kiwis are most blind to, is like the government spending is kind of masking up some of the areas that we should be looking closer at?
The fiscal policy has really been in the spotlight in the post-COVID era. The reason being is obviously the government, rightly so, used its balance sheet to get us through COVID lockdowns with massive fiscal expansion through 2020 and 2021. But by the time you get to about 2022, you do see that the New Zealand economy was starting to look a little bit overheated. We had inflation approaching about 7%. Our current account deficit was approaching about 9% of GDP. Our unemployment rate was at a level that the Reserve Bank would consider not sustainable, i.e. wage price spiral risks are causing inflation to get out of hand. And essentially that meant from about 2022, the Reserve Bank needed to start hiking interest rates. But at the same time, the government kept on spending. So that's what we would call pro-cyclical fiscal policy. And it went into a very broad range of initiatives based on the government's priorities at that time. And even following 2022, 2023 was another big budget, which did more of the same, more pro-cyclical fiscal policy. And ultimately what that meant for anybody with a mortgage is that lack of coordination between fiscal policy and monetary policy. So the Reserve Bank's hiking interest rates, but while the government's running wider and wider fiscal deficits, it ultimately meant that the inflationary impact of those fiscal deficits needed to be offset with a higher than otherwise OCR. So essentially what we're talking about here is a pro-cyclical fiscal policy stance that ultimately meant that in order to make room for that extra demand from the government, given that there was no magic bullet to conjure up additional economic capabilities at the same time, then the Reserve Bank ultimately had to make the private sector smaller than otherwise with a higher than otherwise official cash rate. So we saw this change, this compositional shift between an expanding government, but at the cost of a shrinking private sector. So I think the upshot was there was heaps of spending baked in to baselines at that point of time. It wasn't temporary spending. They baked it into baselines. It's there every single year until the government of the day decides to review it. So when we look at budget 2025, what we had this year, we did see that the government was definitely taking a strong view as to what parts of existing spending can they reprioritize so they don't have to keep increasing spending by the same amount. But at the same time, I mean, they still are running positive growth in nominal spending. It's just happening at a slower pace than it has been previously. I think the government's fiscal strategy in a nutshell is they are consolidating gradually, but they're doing so not by making nominal cuts to government spending. They're doing it by containing growth in government spending. So slow growth in new spending each year, and essentially just waiting for the nominal economy to grow and therefore the tax take to grow and eventually return the books to surplus. That's a pretty slow way to consolidate the fiscal position, and ultimately it could mean that the next big nasty crisis comes along before we're back in surplus, which the big risk with that is if we do see another exogenous shock happen, global financial crisis or something terrible happens globally that hurts the New Zealand economy, it does potentially mean that our government debt to GDP ratio just ends up ratcheting higher again as soon as the next crisis comes along, because we haven't been consolidating the fiscal position while the economy was doing better.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart and subscribe. How is the aging population going to impact GDP growth forecasts and the house price forecasts?
Yeah, well, an aging population presents a lot of challenges in the sense that, first of all, there are concentration risks in terms of who owns what, and our government policies are, first of all, set with respect to things like superannuation policy and the increased health cost, and what do we do as a voting public to basically introduce policies that may change the cost sharing burden of these things on taxpayers. I mean, it's important to remember that there is a big cohort of baby boomers that are drawing down possibly more than they ever put in terms of their superannuation, but also there's associated with that is a very large health bill. But underneath that bubble of baby boomers, there's a big bubble of millennials as well, who I think, just like the baby boomers adopted policies that suited them at the time, millennials are possibly going to do the same thing. And what that might mean in the longer run for tax settings is ultimately it could mean new types of taxes. Capital gains tax, you couldn't rule it out. Some kind of wealth tax, you couldn't rule that out. And essentially, it's because we're in this world where there is a concentration of wealth and assets with the older population, and it's a concentration that isn't really mirrored lower down, which is quite a normal thing. But when you're relying more and more on income taxes to pay for superannuation costs and rising health costs, I think the voting public will, over time, think harder about broadening that tax base, and therefore it could have implications for the types of assets that the older generation own, and housing is part of that. So it's certainly not on this government's agenda, but it's something I think is not going to go away in terms of the public debate, regarding how we tax assets, how we might tax wealth, that kind of thing. I mean, we're not in a position to forecast these types of policy changes, but I think the thing worth highlighting is it's a discussion that's going to continue for quite some time.
And what metrics are you personally watching with regards to listings and sales to help give you strong feelings about where the housing market's going?
Yeah, well, I think what's really interesting in the market right now is I've been calling it a pent-up supply dynamic, where we sort of had this period where people weren't listing their house for sale, so listings were very, very weak. But as interest rates started to come down, we did notice that sales and demand for houses started to increase. But alongside that, inventories and new listings also rose. So the fact that housing supply and demand moved together, it ultimately broadly offset two big forces, broadly offsetting one another, leaving house prices quite stable. So one of the indicators that I put a lot of weight in personally is the ratio, the sales to listing ratio is what we call it. And it can give us up to a 6-month lead on where annual house price momentum is trending. It won't ever give you a super accurate forecast, but it's a really nice sniff test in terms of getting a feel for price momentum in the housing market. And the upshot is that indicator right now is telling us that house price pressures over the coming sort of 3 to 6 months is still looking fairly modest. Certainly not gangbusters, certainly not deteriorating, but only picking up very, very gradually, which would be consistent with our house price forecasts.
Well, I appreciate your insights today, Miles, and recommend anybody that likes data and the deep insights to have a look at the ANZ reports. Look forward to catching up again soon, Miles.
Thank you very much. Yeah, thanks, Andrew.
A final reminder, money moves fast and the investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, just know that someone else is already using this knowledge to make their next deal while you hesitate.